Technical indicators offer powerful insights into what is happening in the market. While price is a factor in technical analysis, volume is as important as price, as this tells traders the level of activity on a given security. The unbalanced volume is one of the most popular volume indicators. Let's find out what it is. Hello everyone, you're on my trading channel. My name is Mary and I can be your personal trader. I created this YouTube channel to share my experience with you, so make sure to subscribe because there will be a lot of interesting content here. If you want to participate in trading sessions with me and receive signals from me, then subscribe to my Telegram channel. The link is in the description. So, what is the unbalanced volume? The unbalanced volume is a trading indicator that is used to assess buying and selling pressure in the market. It shows the buying and selling pressure by adding volume on days when the market rallies and subtracting volume on days when the market closes lower. A market is said to have an up volume only when the price closes higher. On the other hand, a down volume happens when the market closes lower than its prior low close. Unbalanced value will usually follow the market during an uptrend and keep on going higher as the price rallies. That is, both the price and the indicator move in the same way. Similarly, in a downtrend, the OBV will make lower peaks and lower troughs, confirming that the current downtrend in the market is supported by volume. I will show you the chart as an example of how the indicator looks on SPY. The lowest pane with the orange line shows OBV. It goes up and down depending on the intensity of the fall or rise coupled with the volume. However, there are certain scenarios in the market when the OBV falls to react to the price. The following are some of the scenarios that are likely to play out. First one is non-confirmation of uptrend and downtrend. In this case, the price makes a new higher high, but the OBV is unstable to break above its previous high. This is often assumed as an indication of weakness in the uptrend. What this implies is that though prices were advancing and creating new highs, volume is unable to maintain the momentum. It means that the volume does not support the price rise. This particular scenario can and does take place at the end of the uptrend. In a downtrend, the market breaks below its prior low, but just like in the case of the uptrend, the OBV fails to break below its prior low as the price makes new lows, indicating that lesser volume is not supporting the downtrend. At this point, we know that the current downtrend is fading away, which signals the end of the downtrend, advanced breakout and breakdown. Price and volume rise together with each breaking its prior high. However, there are certain times when the price falls to break above a prior high and the unbalanced volume breaks out to create a new high. The implication of this is that although price falls to break out, volume, on the other hand, is significant enough to break above its recent highs. This shows that the price will soon break above its high. Unlike the non-confirmation of an uptrend that shows weakness, the advanced breakout shows strength and a trend continuation. An advanced breakdown tells us of a trend continuation to the downside. This is so because volume breaks below to create a new low, even when the price fails to break lower. This shows that the price will break lower and the downward pressure will continue. Who invented the unbalanced volume? The unbalanced volume was first published in 1963 by Joseph Granville in his book New Key to Stock Market Profits. He stated that the volume was the main force behind major market moves and created the OBV to help spot these turning points in the market based on changes in volume. Granville created the volume indicator for the analysis of stocks, but it has since been used by traders in other financial trading markets such as commodity futures and forex trading. What does the unbalanced volume tell you? Joseph Granville's main idea behind the unbalanced volume is smart money, which is also known as institutional investors. As pension and mutual funds managers begin to get more involved in the market as real investors sell, the volume may increase even though the prices do not react immediately. Price then follows suit, but it is at this time institutional investors get out of the market while retail traders get in it. Even though the OBV does appear on a price chart, little concern is taken about the reading, but rather the behavior of the slope, which is the way of all analysis. Additionally, the reading of the indicator can be used to track large buying and selling, especially that of institutional investors. An OBV sloping downward with a price increase may tell us that the market has reached a turning point as volume is following out of the security, signifying that smart money is exiting the market. But when a downward price move is followed by an upward movement of the indicator, it shows that the market will soon bottom out and reverse back up as more and more smart money is getting involved in the market. As a trader, it is very important to take note of these changes in the indicator because these larger traders move the market most of the time. Don't be like most retail traders who get into the market when institutional traders are selling. Let's see how this strategy works on a real chart. Currently, on the USD and Japanese yen chart, we have an ascending trend. However, the trend is now turning downwards. This indicates that there is a divergence in the market at the moment, and most likely there will be a breakout on the downside. We can see that there is a small support level below. I doubt it's strong enough and will probably not withstand the pressure. So I'm going to open a short trade for 3 minutes with $1,000. Since the indicator shows a divergence, I will wait for a downward breakout and a trend breakdown. Additionally, a wedge pattern has formed on the chart. It's almost converged, indicating an imminent impulse move. Furthermore, this wedge is ascending, which means it's currently against us. In theory, the price should rise, but I'm trading based on the unbalanced volume indicator. This indicator rarely makes mistakes. It suggests that the price will break the trend to the downside minute by minute. Unbalanced volume, or OBV, takes trending volumes into account. The higher the number of trades currently trading in the market, the higher the trading volumes. And when there are volumes, it means that the trend will maintain its direction. If a divergence appears, it means traders are no longer trading at current prices and the trend breaks. The market first loses momentum and then reverses. But there is one aspect to consider. The trend reversal doesn't happen immediately, it occurs gradually with the loss of momentum. Often the indications of the OBV indicator anticipate the trend's movement because investors with significant capital start taking positions before regular traders catch on. In simpler terms, investors are selling their assets now, while regular traders are buying them. Later, when they realize the price has stopped rising, they start selling. That's how it works. Now, the price has already started moving down and my trade is in profit. I expect an even stronger downward impulse. Let's wait for the close. Only 5 seconds left and the trade closes in confident plus. The price hit a support zone and bounced back, but not high enough to cause me a loss, so in just 3 minutes I earned $910, an excellent result. Thank you for watching. Like and subscribe to the channel. If you want to participate in trading sessions with me and receive signals from me, then please subscribe to my Telegram channel. The link is in the description. My name is Mary, and I'm the best trader.